Equity Market Update, November 2023. Indian equity markets rose significantly during the month, and Nifty and S&P BSE Sensex ended the month approximately 5% higher compared to a month ago. Mid-cap and small-cap index outperformed the large-cap benchmarks. Key events and drivers during the month include rising consensus that US Fed rate has peaked and probability of US recession is receding, fall in oil prices, temporary ceasefire between Israel and Hamas, revision of US sovereign rating outlook to negative from stable by Moody's, resilient domestic growth, etc. Most sector indices rose month-on-month, with oil and gas, healthcare, power, auto, capital goods and metals being the key outperforming sectors. Most global equity indices rose across AEs and EMs. FPIs bought equities worth $1.1 billion in November 2023, as opposed to net equities sold worth $3 billion in October 2023. FPIs have bought equities worth $16 billion in 8 months FY24. DIIs, on the other hand, bought net equity worth $3.4 billion in October 2023 and have cumulatively bought equity worth $9 billion in 7 months FY24. Flows to mutual funds increased to approximately INR 27,000 crore in October 2023 compared to approximately INR 24,000 crores a month before. Cumulatively, MF flows in equity-oriented schemes in 7 months FY24 stood at approximately INR 112,000 crores. In Q2 FY24 results, earnings of PSU banks, oil and gas, auto, pharma and capital goods sector were better than expected, while that of private banks, NBFCs, metals, cement, consumer staples and durables were in line with expectations. Results of IT and chemicals were lower than expected. Outlook. As on November 30, 2023, Nifty 50 was trading at approximately 18.7 times FY25 estimated price to earnings multiple. Further, market cap to GDP stood at approximately 102%, and the gap between 10-year G-Sec yield and 1-year forward Nifty 50 earnings yield also remains high. Current valuation multiples are at a slightly elevated level vis-à-vis the historical averages. However, one should view these valuations in the context of structurally attractive nominal GDP growth, a healthy corporate earnings outlook, and robust delevered corporate and banking balance sheets. Except for banking, valuations for most major sectors are higher than long-term averages. The sharp broad-based rally in the current financial year has resulted in small-cap and mid-cap indices significantly outperforming, and they now trade at a material premium to their long-term average valuation. However, large-cap valuations remain at a modest premium. We remain positive on equities over the medium to long term, considering the structurally robust domestic growth outlook, healthy corporate profitability, and pro-growth policies. A sharp slowdown in global growth, escalation of geopolitical tensions, and re-acceleration in inflation, globally or locally, are material near-term risks. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.